Hello traders, Gary Wagner here. Approximately 1:30 in Honolulu, 7:30 in New York on Tuesday, 31st day of August 2021, and this is the daily report for gold and silver. We saw moderate gains in gold and a moderate decline in silver today as traders await Friday's jobs report, which will undoubtedly be the most important event that occurs this week. Depending on whether it comes in above or below estimates, will determine the future direction of both gold and silver. We'll talk about that during the show, which begins now. Although gold is trading below the highs and closing price achieved on Friday, it is only a couple dollars away from Friday's closing price at approximately $1,820. Currently, we have gold up $4.20, about a 0.25% rise in price, and is fixed at $1,816.40. Now, the dollar didn't really play a large component. There was fractional gains in the dollar index, gaining 0.023 points or 0.02% on the day. But the most significant factor of the trading range today in the dollar was a plunge to a low of 92.39, breaking well below its 50-day moving average, although it did recover above that. We'll look at the dollar when we pull up a couple of charts. We are looking at a daily candlestick chart of December gold futures, but before I go into the analysis of this chart, I want to address a question that was posed by one of our subscribers, initials DM, and he asked why we were always emphasizing Australia, small market, who really cares what happens there? Is there some significance you ascribe to that I am missing? Well, the first thing that I would want to say is it is the first market that opens up for the trading day. Here in Hawaii, as well as the mainland, it's Tuesday. Trading has begun in Australia on Wednesday. But more importantly than that, we're trying to get a sense for how the Asian market's going to react, and also in London. And the first indication of that is when trading resumes in Australia. Realize that this market is a global market, and what happens in Asia matters, what happens in London matters, and yes, Australia is the smallest component of the different areas that we follow gold. It is an important market to look at because it's our first indication of what is happening following the close in New York. That being said, let's take a look at this chart. What is most significant to me is not so much the rise in gold today, it is the fact that it opened and closed above both the 200-day and 100-day moving averages. Now, if you look closely at those averages, what you'll see is that yesterday we detected a potential cross as the 100-day in blue has now moved above the 200-day. I said yesterday that it really needs to fully form, and it really hasn't fully formed yet, but you can see that ever so slightly it is widening. And on a technical basis, that is an extremely bullish factor. I still see resistance that begins at approximately 1827, the 61% Fibonacci retracement, up to these recent tops that occur at approximately $1,835. That being said, that is a critical area for us to see gold pricing break above. But here's the key, traders. It is all going to be about the jobs report released on Friday by the U.S. Labor Department. Currently, the projections are that that report will indicate an additional 600,000 individuals are now on payrolls. That is being largely factored into the market, as we've spoken about, and it's whether it comes in well under or over these estimates that would cause the greatest move in gold. My personal sense is that I don't believe it's going to come in very much over estimate, if at all. I would look for it to come in around estimates to maybe even lower, because we have that unknown about the Delta variant, and that Delta variant is definitely slowing down the economic regrowth that has been occurring over the last 3 months. It could throw a real wrench in the wheel. We could work our way through it, but it is absolutely an unknown. If gold is able to continue to rise, and if that rise takes current pricing above, let's call it 1835, our next real target is going to be 1866. That is based upon the 78% retracement area. We can see some historical data that showed it as a potential support area. And once it broke below there, it dropped very, very quickly and very dramatically down to these lows just below $1,770. That occurred mid-June throughout the end of June before it started moving back up at the beginning of July. We're looking at a daily candlestick chart of the dollar index. We can see that it did close lower compared to the open, a little bit above yesterday's close. But as I said, when we looked at the price board, what is most significant is this free fall to lower pricing breaking below the 50-day moving average. Considering that the dollar was trading as high as 93.75, and this occurred really about the mid of August, we have seen prices drop in terms of relative value of the dollar index of just over 1% in the last 2 weeks. However, silver did not follow the same direction of gold today, closing lower by approximately 8 cents. That is about a 0.3% decline, with the most active December futures contract currently at $23.92.5. And traders, although gold is showing some real bullish momentum, I don't believe that silver is showing the same strength. Today closing lower by about 8 cents and is currently fixed at $23.94. One of the reasons when we sent out our trade alert yesterday that we gave subscribers a choice to either just pull profits or to pull profits and then roll that into a December position is, although I am bullish on silver, I believe that gold could in fact outperform any potential gains that could be realized in silver. Today, Bloomberg News interviewed John Paulson, one of the more famous hedge fund managers who correctly predicted the fall of the housing market that led to the recession of 2008 and 2009. I've included the entire interview because it's important to see what he has to say about gold. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review, and please enjoy the interview that will begin now.
Our viewpoint is that the markets are currently too complacent regarding inflation, and that if inflation does prove to be higher than expectations, that will result in both higher gold prices and higher interest rates. And if you get those two happening at the same time, in a period of time, we can set up positions that could, return from 25 to 50 to 1.
Now, after you made your famous trade that we talked about, I think you put on a trade where you bought a lot of gold or gold futures, and you were what was called by some a gold bug. You're a big believer in gold. Gold's now about $1,700 an ounce or so. Are you believing that gold is now a good investment at this price?
Yeah, we do, and thank you for bringing that up. We do believe that gold does very well in times of inflation. We saw what happened the last time gold went sort of parabolic was in the 70s when we had 2 years of double-digit inflation. And the reason why gold goes parabolic is that basically it's a very limited amount of investable gold. I think it's on the order of several trillion, while the total amount of financial assets is closer to 200 trillion, and fixed income somewhere above 120 trillion. So what happens is if you own long-term treasury bonds that are yielding 2% and interest rates move up to 5%, those bonds fall materially in value. Likewise, if you have cash sitting in a bank that you're earning 0% on, inflation's 4%, you're gradually eroding the value of your money. So as inflation picks up, people try and get out of fixed income, they try and get out of cash, and the logical place to go is gold, especially if it starts to rise in inflationary times. But because the amount of money trying to move out of cash and fixed income dwarfs the amount of investable gold, that the supply and demand imbalance causes gold to rise. And the more it rises, it sort of feeds on itself and has the potential to go what I call parabolic.
So today, you are a big believer in gold as a good investment now?
Yeah, so we thought in 2009 that with the Fed doing quantitative easing, which is essentially printing money, that would lead to inflation. But what happened was that while the Fed printed money, they at the same time raised the capital and reserve requirements in banks. So the money sort of recycled when the Fed bought treasuries, created money, wound up in the banks, and then was redeposited at the Fed. So the amount of excess reserves at the Fed almost rose by the same amount they were printed, and the money never really entered the money supply, so it was not inflationary. This time around, the money has entered the money supply. So the money supply was up something like 25% last year. And the best indicator of inflation is money supply. So I do think we have inflation coming well in excess of what the current expectations are.